Well, joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. I just wanted to get a check firstly on today's trade, and we're still seeing very much the same themes. The narrative, as it were, remains very much unchanged.
Yeah, you're exactly right. I mean, dollar long has got exhausted yesterday. Today, when we're on the eve of the OPEC meeting, we have the Italian referendum, also have a labor report coming out at the end of the week. So really, most asset classes behind me here are pretty quiet, pretty muted, people just squaring positions, just not knowing, just realizing that people were wrong with Brexit, people were wrong with the U.S. election. Who knows what will happen with the OPEC meeting?
Well, as you mentioned, with few macro drivers really in the market, I guess investors are now really having to decide, whether they got their Trump trade right or not, and if that will see them through to the new year. What's your thoughts on this?
Yeah, I think most of us got the Trump trade wrong. I mean, not many of us were short bonds, long U.S. dollar, long equities, long drug stocks, banks, cyclicals versus defensives. But all that to say, with the convergence of tax breaks and infrastructure spending, it does seem that this rotation will have some legs to it. And that's why we're starting to see small cap outperform large cap. We continue to see a rotation from into cyclicals, out of defensive stocks, and also people continue to sell emerging markets, knowing that the U.S. dollar has some room to run.
Okay, so let's touch on that OPEC meeting, as you mentioned. And indeed, we seem to be having a pre-meeting to the pre-meeting to the pre-meeting of the big meeting, and still no resolution has been made.
Yeah, exactly. There's so many questions no matter what happens, and that is OPEC going to stick to their prior goal of 33 million barrels per day? Are they going to have specific country quotas? Is Russia going to do more than just cut production? And how about Iran and Iraq? I mean, what's going to happen there? So I think, the proof is in the pudding. Watch not what a man does, or what he says, but what he does. And I think that's going to be the case. I do believe we'll have a really big knee-jerk reaction to it all. But again, there's questions that will be emanating from the meeting that won't be answered right away.
Well, we had analysts yesterday, Morgan Stanley and Macquarie, coming through with a $43 price target if no deal is done. Analysts here, again, very much in the 42, 43 bracket. You're, however, suggesting we could even see a fall to the low 30s with no deal.
I do believe that. I think we're going to see mid to low 30s if there's no deal, and perhaps as much as mid 50s if there is a deal, a convincing deal. That said, I'm slightly more to the camp of there being a deal. I do believe at the end of the day, financial incentives will definitely trump society and culture. The fact is, OPEC understands the risks so much better than they did in November 2014. Nobody wants to repeat that. And let's face it, most countries are close to their production limit anyway, so it's not that big of a deal. I think that's something we have to, really keep in mind. And also, they want a balanced market. And we probably would have been close to one if it wasn't for the influx from Libya and Nigeria this year. So to cut the production, to get closer to a balanced market is what they want. So I am tipping closer to there being a deal tomorrow.
Just in terms of that deal, what is the criteria in your mind of a successful deal? What measures need to be put in place that will satisfy, the majority, if not all, members, and essentially get that production cut done?
Yeah, I think it's a minimum. We're talking about bare minimums of like a 6-month deal, because that's the thing. When's the production cuts going to start? Is it next month or is it next year? So there's got to be a 6-month duration to it at the very minimum. We need to see at least 800,000 barrels per day cut in production, and we have to see something that's credible, verified, and something that countries can, in fact, enforce against one another. So if that doesn't happen at a bare minimum, then I do believe it's going to be chaos beginning of the next couple days.
I just wanted to shift focus ever so slightly. As I mentioned in the intro, we are seeing a real move in iron ore prices also, and in fact that iron ore rally really stalling, and prices have dropped after hitting their highest level since October 2014. In fact, we have a chart on screen at the moment for viewers highlighting that. How closely are you watching these iron ore moves, Larry?
I'm watching them quite closely. I mean, we have exposure to the industrial metals. Iron ore has been very tricky. In general, the industrial metals have seen a pretty good rally this year, considering the sheer amount of headwinds that they've faced. But, you know, with that in mind, you know, the iron ore story is largely a China story as well. And not everybody likes the so-called published reforms that China is going to announce, more structural reforms as opposed to monetary reforms. So with that said, it just kind of put iron ore, et cetera, into a short-term tizzy. But I do believe long-term, meaning even next year, we will see iron ore slowly go back to where it belongs.
So within your portfolio, how are you allocating yourself then across the asset classes, if we kind of take into mind some of the themes that we have discussed today?
Yeah, well, one is I'm overweight cash, and not because I'm scared, but more because I think we're pricing in extremes. We can see that in all the markets, except for the equity market. Everything else has been priced in extremes. So I'm holding on to a lot of cash, waiting for a crazy opportunity, like if oil should go down to the low 30s or up to the mid 50s, and I can take advantage of that. Other than that, from a trading perspective, I still would maintain a short in gold. I would be long, small cap versus large cap in the U.S. Cyclicals over defensives. I do like healthcare, energy, and bank stocks. Continue to like them, but I also would keep an eye on emerging markets. For as quickly as they went up, they went down. I think there might be some bargains over the next month or two.
Absolutely. Well, I mean, even despite that fall that we have seen in the oil price, U.S. markets still pushing higher still. Larry, we will leave it there. Thank you so much for your time today.
Thank you.